Welcome to Economy Unpacked. The Reserve Bank has infused 9.5 trillion rupees of liquidity since January and has cut repo rates by 100 basis points. The call rate actually has fallen more. It's fallen from 6.75% in January to 5.25% in June. Now, the question we're asking is this enough to increase credit growth, which had fallen to a low of 9% in year-on-year terms in June? A JPMorgan study argues that higher liquidity can pull down call rates by a quarter basis point below the repo rate. But higher liquidity by itself cannot increase credit growth, which depends on other factors. Maybe they mean factors like animal spirits of businesses. Separately, historical evidence shows that the Reserve Bank lowered rates from about 10% in FY98 to 6% in FY 2004. But for the 4 years from FY 2000 to FY 2004, credit growth remained muted. At that time, 15% was considered muted. However, it raised interest rates from 6% in FY 2004 to 8% in FY 2008. And credit growth rose in those years by around 25 to 27%. So the question we are asking today is, should we expect strong credit growth given the high liquidity and credit rates announced by, rate cuts announced by the Reserve Bank? Joining me are Sajjid Chinoy of JPMorgan, Indranil Pan, the economist from Yes Bank, and Mr. Rajkiran Rai, Managing Director of NABFID, and of course, former Managing Director of Union Bank. Gentlemen, thank you very much indeed for your time. Sajjid has just published an extremely erudite paper on this. Sajjid, in simple terms, why are you arguing that liquidity is not enough to boost credit growth?
Thank you, Latha. The motivation for our piece was over the years, there's been a rich debate about what role liquidity plays in addition to rate cuts or rate hikes in the monetary transmission process. Should the surplus or deficit be 1% of NDTL? If you inject more liquidity during easing cycles, do you get more transmission? Will that help credit growth? And there are two main channels of transmission that the debate is centered around. Does more liquidity result in higher interest rate transmission? So it pushes call rates down, as you said. But beyond that, does it push lending rates down for banks if you inject more liquidity? And the second channel, in fact, is more important, something that Ben Bernanke argued over the last 20 years, what's called the credit channel of transmission. That if there is a lot of availability of liquidity, then banks tend to lower lending standards, lower risk standards, and credit growth picks up irrespective of interest rates. So what our study did was over the last 10 years, look at both these channels quite rigorously. What did we find? Number one, that liquidity clearly has an impact on call rates, about 25 basis points, as you said. But beyond that, once you adjust for the call rate or hold it constant, there is no incremental impact of higher liquidity on lending rates. So all the transmission works through call rates. Number two, and this was the interesting finding because in a way it's slightly different from what the RBI had found back in 2012, that really liquidity by itself does not cause higher credit growth. We've looked at this in many different ways over the last 10 years, and we find no evidence that just injecting liquidity by itself does not boost credit growth. So there is no evidence in India of a credit channel of transmission. The third and final finding was, when we talk about what's driving what, does deposit growth drive credit? Does credit drive deposit? And we find it's the latter. It's really credit that's the initial mover. It's credit growth that drives deposit growth, which in India's context is good news because it means the credit deposit ratio over periods of time tends to mean revert. Now, I'll make one final point. This is not to say that credit growth will not pick up in this cycle. As you pointed out, call rates are down 150 basis points. We find in our work that there's an 80% transmission on average to lending rates. So over the cycle, expect lending rates to go down by 100 basis points. That should, of course, help credit growth. But as you also pointed out, what we find is this positive correlation between lending rates and credit growth, which is very intriguing and interesting over the last 20 years. That is really, credit growth seems to be associated with higher lending rates, which tells you that apart from movement down the demand curve, what matters in India is whether the credit demand curve itself moves out, which is a function of growth prospects, private investment prospects, animal spirits, and the like. So these were kind of the findings that we concluded.
Okay. But let me tell you a story that I heard from bankers around the time when you presented the inflation targeting report along with Urjit Patel, you were part of that committee. You know, the Reserve Bank at that time, because of the Urjit Patel report and the Mohanty committee report, said that, you know, to keep repo rate at the, keep the call rate at the repo rate, we have to keep liquidity slightly less. Only then the policy rate aligns with the repo rate. But because of that, people were not cutting rates. When the Raghuram Rajan RBI asked bankers, why are you not cutting? We have cut rates. They said, see, as long as we are borrowing from RBI, our psyche is there is not enough money. So we are not cutting deposit rates. So you keep liquidity in plenty, then only I will cut deposit rates because I feel, okay, I am not borrowing from RBI or from call market. This was the psyche that bankers explained to RBI. Those two bankers, Hitendra Dave and Anant Narayan at that time, now in SEBI, said that even on our channel. So Rajkiran Rai, is that the argument that bankers want liquidity and otherwise they won't cut rates? So liquidity has a role in rate transmission.
Definitely, yes. Actually, see, liquidity is very important because you would have seen the deposit growth in the system moderated a lot actually because there was tight liquidity in the system. Another factor is actually when the credit growth slows down, the deposit growth also slows down. So I think these are all very interlinked. Sufficient liquidity in the system has already brought down the short-term interest rates, is already helping in cutting the deposit rates. You would have seen the banks have cut deposit rates substantially now. So now actually it will play out. It takes time. But then the argument is right that bankers will always look for liquidity, tight liquidity conditions. Actually, banks compete with each other for bulk deposit, for deposit growth. And when the deposit rate goes up, the interest rates are always kept high.
Okay. No, I think we are not just, tight liquidity obviously will not push up credit growth. But what Sajjid is arguing, I guess, is that just surplus liquidity is not enough. Sajjid, I'll come back to you for your rebound reaction. But Indranil, where do you stand? Do you think surplus liquidity gives bankers the psyche to pass rate cuts, and that in turn should logically increase the demand for credit? You're on mute.
Hello. Sorry, I think the context here is more in terms of what is the extent of liquidity that you are talking of. Now, for example, in the current scenario, we are almost a 4 trillion surplus in terms of liquidity, and the RBI has absorbed only about a 1 trillion through the VRRR. Now, again, I think that going back, the whole argument boils down to whether you operate at the lower end of the corridor. And in that case, it is only the near-term securities in terms of the T-bills or etc., which actually get the transmission at the highest level. The credit growth possibly doesn't happen, and the credit growth will depend a lot in terms of the type of demand for credit that is there. Now, in the current circumstance, I'm not sure whether a 2 trillion or a 4 trillion can push up credit growth very significantly, simply because of the cycle where we are in. First of all, I think the FSR report also did point out that there is an increase in per capita debt for the subprime category borrowers. And therefore, to that extent, the credit demand, which is basically the housing sector, obviously is the prime category and the super prime category, but more in the middle segment where you still have a stress in terms of the post-COVID debt weight loss. Okay. That is the zone where credit has been increasing the maximum. And that's possibly where the banking sector had also been hurt in terms of the incremental NPAs over the last couple of years. Okay. So in terms of credit standards or the risk undertaking that the banks are willing to take even for that segment may actually be relatively lower. The RBI also had increased risk weightages over there. Okay. So I think there's a lot of things. It's not only liquid that impacts the credit growth cycle. It also depends significantly in terms of both banks' risk-taking capability as well as the demand.
Got it. Mr. Rai, you wanted to react?
Yeah, actually, let us expand this discussion because we are trying to connect liquidity, interest rate, and credit growth. Now, you cannot limit the credit growth only to the scheduled commercial banks because growth is happening somewhere else. Because infra space where I operate, The scheduled commercial bank number, if you see, they are minus 1%. But if you look at the NBFC and AFI space, they have grown 15%. Look at the InvIT assets under management. Now today they are 7 lakh crores. They have grown 10 times in last 5 years. They are expected to be 20 lakh crores. The flipping of the assets from the scheduled commercial bank.
That expands beyond. I'll come to that. We are at the moment looking at whether bank credit can grow. Right? Sajjid, you wanted to react. I mean, liquidity does give bankers a psyche of being able to cut deposit rates. Although you are not lending the reserves, but it gives you the comfort.
There's no doubt about that. And I think the point here is that we've recognized over the years that the first leg of monetary transmission, as the Inflation Targeting Committee report had laid out, was to ensure that the operating target of monetary policy, which is overnight money market rates, the call money rate, the TREPS rate, align more closely with the policy rate. Now, it's turned out that that typically involves keeping liquidity in a modest surplus, right? That if you keep liquidity in a deficit, you will not achieve that transmission, because typically, given the distribution of liquidity between banks and non-banks, overnight rates will be above policy rate. So I think the system has recognized that keeping liquidity in surplus is almost a necessary condition to keeping overnight rates towards policy rates. The simple point that we're making is once that minimal objective has been achieved, the incremental impact of adding more liquidity, once it's already in a modest surplus to overkeep, doesn't give you much efficacy. It doesn't give you much efficacy, at least in the data, either on lending rates to get lending rates to go down more or deposit rates to go down more, or it doesn't give you more efficacy on credit growth itself. And that was the limited point we were making.
Okay, I have more questions in terms of, worries about IBC, worries about asset quality, which may also hamper banks from giving loans, which is, at the moment, that's positive. But I'll come to those questions in just a bit. First, give me a rapid-fire number. At the moment, in FY26 itself, what is the kind of credit growth you guys are expecting? First, Indranil?
9.5 to 10%. High base of the last year will bring down the YOY number.
Will bring down the YOY base. Okay. But the YOY base for June is 9%. I mean, at the moment, we're running at 9%. You expect that through the year, it's going to remain around 9.5, 10?
9.5 to 10.
Okay. Sajjid?
So typically, it's about 1.1 times nominal GDP. If you assume nominal GDP of 10, we should be looking to take credit towards the, somewhere around 11% or so on a sustainable basis for this year.
So we should have 11. Mr. Rai, you have a guess?
Yeah, it is around 11 to 12%. I'll also give you another logic to this. See, we were in a monitoring tightening cycle, particularly NBFC lending and unsecured personal loans and all that. And only like last few months, this is being relaxed. So this will play out, and I think we'll end up with 11 to 12% growth.
Okay, fine. So I have a 9.5 to 10, and I have a 11, and I have a 12% over here. But it is still not 13 or 14, as some would like it to be. After the break, I have two very important questions for you. One, whether there is animal spirits enough in the market for credit to, take off. And separately, the fact that banks have clean balance sheets, does that make them more risk-prone? Those questions after the break. The entire show will be available on CNBC Access. For Bazaar viewers, it's now time for Chartbusters.